Russia attacks Ukraine. Those are the headlines that are swamping the media this morning. Markets under severe pressure as we start to look at the impact of this invasion on financial assets. That's today's edition of 3 Minutes on Markets and Money. Lots of concern this morning as stocks are set to open sharply lower. Markets did close yesterday right on support running back going to October. We've been kind of warning about this retest of lows, and the close yesterday set right on the intraday close of the markets back in January. So nothing wrong as of the close last night. This morning, very different story. Markets set to open sharply lower, down about 100 points this morning on news of the invasion of Ukraine. The question is how much more is there to go to the downside? What we can do is look at how markets responded previously when Russia invaded Ukraine in 2014. In early 2014, Russia invaded Ukraine over the issue of Crimea. That occurred in February of 2014. And looking at the chart, you see the market opened down very sharply that day, remained low the entire day, but that was the bottom actually of the market. The market had already been declining previously to that, had gotten 3 standard deviations oversold from the moving averages on the day that Russia invaded Ukraine. That was the bottom, and of course the market rallied after that. Now, again, as we saw that recovery, that was because people started to understand what the actual impact was and that there would eventually be a resolution to this. Is the market going to respond the same way today? I don't know, but we do have some very similar setups to what we saw previously back in 2014. Let's take a look at that. If we take a look at the market today versus what we saw back in 2014, we did see the peak of the market in early January 2014, just like we saw the peak of the market in early January of this year as well. On the day of the invasion, the market got extremely oversold, pushing into 3 standard deviations below the 50-day moving average, exactly where we're going to be this morning at the open. So again, the markets were already anticipating much of what was going on in the markets then, and have already anticipated much of what's going on in the markets today. The point here is to be careful about knee-jerk reaction, making selling in your portfolio today, being overly concerned about where we are. Markets are under pressure, no doubt about that. We've been buying bonds and portfolios. We added a short position to help hedge some of this risk in the markets. And again, we're looking for an opportunity here to actually add money back into portfolios. The other thing is that the increase in the geopolitical risk is also going to start to cause the Fed to reassess their position of hiking interest rates and reducing monetary policy. That could also provide a support for stocks, at least in the near term. But the point is very clear here is that markets are extremely oversold. And just like we saw back in 2014, that was actually the bottom of where the markets actually found some support. Again, we're 3 standard deviations oversold. We're very deviated to the downside. Markets are very oversold on virtually every level and every indicator at this point. So again, be careful making a knee-jerk reaction here because of emotionally driven headlines. Come back to what the portfolio's doing. We're looking to hedge more risk. We're looking to reduce some equity risk. We'd like to see a little bit of a recovery today to sell into to increase cash levels here a bit. But again, we're also being very cautious about understanding that markets are very oversold and very negative, and this could very well be the bottom, at least in the short term, for a reflexive rally over the course of the next couple of weeks. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you the next time.